Hello there. Welcome to this guide brought to you by the experts over at Pro Tax Accountant. Today we are going to get to grips with something that can save UK employers a massive headache, the PAYE Settlement Agreement.
You know how it is, right? You do something nice for your team, maybe a celebratory meal or a small gift to say thanks, and then, boom, you're suddenly drowning in paperwork, trying to figure out all the tax implications for every single person. It can honestly turn a really great gesture into an admin nightmare.
But what if I told you there's a much smarter way to handle all of this? A fully HMRC-approved method that's actually designed for these exact situations. It saves you time, keeps you compliant, and most importantly, keeps your team happy. Right, let's get into it.
So here's what we're going to cover. First, we'll talk about what we call the benefits headache. Then, we'll introduce the solution, the PAYE Settlement Agreement, or PSA for short. We'll look at the pros and cons, what's in and what's out, how you actually get one, and, this is the big one, how to calculate the cost. Then we'll wrap up with some of your most common questions.
Okay, so let's start with the problem. It's a frustration that so many business owners know all too well, whether you're a freelancer in London with just a couple of staff or a bigger company anywhere in the UK.
So, the traditional way to report a lot of these benefits is on a P11D form. And honestly, it's a real challenge with small perks. I mean, how on earth do you put a value on each person's share of a team party or that one-off gift? It just creates this huge administrative burden. And if you get it wrong, you risk falling foul of HMRC. Plus, let's be honest, nothing kills the buzz of a thank you gift quite like telling your employee they now owe tax on it.
And that brings us perfectly to the solution for this mess. This is exactly where the PAYE Settlement Agreement, the PSA, steps in and saves the day.
So what is it exactly? Well, a PSA is a formal agreement you make with HMRC. It's completely voluntary, and it lets you, the employer, settle all the tax and national insurance on certain benefits with just one single annual payment. Think of it as a way to just bundle up all those fiddly little tax bits into one neat, tidy package.
Now, you can't just throw everything in there. For a benefit to qualify for a PSA, it has to meet at least one of these three key criteria from HMRC. It has to be either minor, irregular, or impracticable. Let's quickly break down what each of those actually means.
First up, minor. We're talking about small, low-value things here. You know, like sending a bouquet of flowers to an employee who's unwell, or maybe a small birthday gift that doesn't quite fit the strict rules for the trivial benefits exemption.
Next, we have irregular. This is for benefits that don't happen on a regular basis. It's not something your employee expects every month in their contract. A perfect example is if you help an employee with relocation costs that go above the $8,000 tax-free limit. It's a one-off, not a recurring thing.
And finally, impracticable. This one's a lifesaver. It's for those times when it's genuinely difficult, if not impossible, to work out the value for each person. The classic example is a big staff party or team-building away day. It's just not practical to divide up the cost of everything and a slice to every single employee.
Okay, so now we know what a PSA is and what kind of things can go in it. The next big question you should be asking is it actually the right move for my business? So let's weigh up the good and the bad. So on the upside, it's pretty clear. For your business, it means way less admin and peace of mind that you're compliant. For your team, they get their perks completely tax-free, which is brilliant for morale. But, and this is a big but, here's the downside. Your business has to pay the entire tax bill. And it's not just the tax on the benefit, it's what's called a grossed-up cost. It means you pay tax on the tax itself. Stay with me, we'll explain that in just a moment.
So, what kind of things typically go into a PSA? Well, we're talking non-cash gifts and vouchers, staff parties, maybe some employee awards, those extra relocation costs we talked about, or even shared things like the use of a company minibus. Basically, anything where tracking the individual value is just a total pain.
Now, it's just as important to know what you can't include. And listen up, because this is where people often get caught out. You can't put cash in a PSA, so no wages, no cash bonuses. High-value items like company cars or private medical insurance are also out. They have their own special tax rules. And anything that's a regular, contractual part of someone's package has to go through your normal payroll.
All right, so if you're sitting there thinking, you know what, this PSA thing sounds like just what I need, let's look at how you actually get one set up. The good news is, it's probably more straightforward than you think. It's really a four-step process. First, you apply to HMRC, either online or by post, and you tell them which benefits you want to cover. Second, they'll send you a form called a P626. You sign both copies, pop them back in the post, and they'll send one back to you as your official agreement. Third, when the tax year is over, you do your sums and work out the total tax and Class 1B national insurance you owe. And finally, you report those figures and pay the bill. Simple as that.
Now, there are a couple of dates for your diary that are absolutely critical. The first one is the 5th of July. That is the deadline to apply for a PSA for the tax year that just finished. If you miss that date, that's it. The opportunity is gone for that year, and you're back to using P11Ds.
The second key date is for paying what you owe. The deadline is the 22nd of October, after the tax year ends, assuming you pay electronically. If you're still paying by check, it's a little bit earlier, on the 19th of October.
And here's a fantastic pro tip for you. Did you know that once your PSA is set up, it's an enduring agreement? That's right, it just rolls over. So you don't need to apply every single year, which is a massive time saver. But, and this is vital, you should still give it a quick review each year to make sure it's up to date and still covers everything you needed to. Okay, now for the part that can feel a bit tricky, calculating what this all actually costs. But please stay with me here, because understanding this is absolutely key to deciding if a PPSA is the right financial move for your business. We're going to demystify this thing called grossing up.
So here's the logic. Because you, the employer, are paying the tax bill that the employee would normally have to pay, HMRC sees that payment itself as an extra benefit to the employee. And so you have to pay tax on that tax payment. I know, it sounds a bit strange, but this grossing up process is what makes sure your employee feels zero financial impact from the benefit they receive. So how does the actual maths work? Well, the core idea is pretty simple. You take the value of the benefit, and then you apply a calculation that basically adds the tax on top of it. That gives you the total grossed up value, and that's the number that you then pay tax and national insurance on. Let's make this real with a 2025/26 example. Say you give an employee a £100 gift voucher. For a basic rate taxpayer who pays 20% tax, the grossed up value becomes £125. Then you add on the Class 1B national insurance, so that lovely £100 gift actually costs your business £142.25. But that's not all. Here's where most people go wrong. They forget about higher earners. For a higher rate taxpayer on 40%, that same £100 gift ends up costing your business a whopping £189.67. The cost can almost double the original value of the perk. Whew, we have covered a lot of ground there. So to finish up, let's run through some of the most common questions people ask about PAYE settlement agreements. First off, can you include directors? Yes, absolutely. The same rules apply to them as to any other employee. What if you miss that critical 5th of July deadline? Well, as we said, the option is gone for that year. You have to go back to the old way of reporting on P11D forms. And the big one, is a PSA always the best choice? Honestly, not always. That high grossed up cost is a very real factor. You really have to weigh up whether the admin savings are worth the extra cash you'll be paying out.
And that really brings us to the final thought I want to leave you with. Looking at your business, your team, and your budget for 2026, is a PAYE settlement agreement the right strategic move for you right now?
And just a very quick but important note before we finish. The information we've shared today is for general guidance. Tax can be incredibly complex, so you should never rely on this exclusively to make financial decisions. And for that expert, tailored advice, the team at Pro Tax Accountant is there to help. They can look at your specific situation and figure out if a PSA is truly the best fit for your business. You can reach them directly on WhatsApp or give them a call on 07985 689912. Or, if you prefer, you can drop them an email at info@protaxaccountant.co.uk. And if you'd like to read through all of this in more detail, you can find the full article over on the Pro Tax Accountant blog. And finally, for more simple, helpful guides just like this one, make sure you hit that subscribe button on the Pro Tax Accountant YouTube channel. Thanks so much for watching.